This podcast channel is about you, successful international entrepreneurs, successful expats, successful investors. Sponsored by HCJ.tax. Hello, good evening, everyone. Yes. Good evening, everyone. Thanks for joining us here, HCJ.tax. We have webinars and live streams probably every week on various topics of interest to people who are international entrepreneurs, investors, or expats working overseas, working outside of the US. So today we have the honor and privilege of joining us, Mr. Boon Yip Yee. Sorry, those who have just joined, please could you remain mute? There'll be an opportunity at the end for you to unmute yourself for the Q&A. So thanks for that. So joining us, we have Boon Yip, and he is a qualified Singapore tax advisor and qualified accountant. As we've done in previous sessions, what we're going to do, because I know you guys joined with specific questions in mind, so what we've done is modified it from what we did previously, where we went through like a PowerPoint and then we went into the Q&A. So we're going to jump into the good stuff, which is what you signed up for, which is a Q&A. Some of you have sent questions in advance and comments in advance. Thanks for doing both. Those who have not done so, depending on which platform you're going to be viewing this, if you're on Zoom, just look to the chat box below and you can type your questions there. If you're on LinkedIn, Facebook, Twitter, YouTube, you can type your questions or comments into the boxes below, and we get to them in the order in which we have received them. So without further ado, I'm gonna just jump into the questions that were previously submitted. Number one, what are the tax breaks for those starting a Singapore private limited company? Boon Yip, I think this is one for you.
All right. So, okay, basically there are different incentives available for new entities. I mean, new startup. Okay, for the first 3 years of the incorporation. So, company entitles actually a lower effective tax rate. So the headline tax in Singapore is 17%, but as we know, very seldom for SME to pay a 17% tax. So it goes on to a tier. Okay, so I think new entities is paying about 4.25 effectively, and beyond 3 years. After the 3 years tax break, probably you will be at a higher rate, 6 to 7%. So if you look at the chargeable income, if you are having $1 million Singapore dollars of chargeable income, effectively you are still paying something like, if I'm not mistaken, it's about 15%, less than 15%, right? So effectively it's still lower than some of the major competitive economic countries like Hong Kong, right? So that would probably be the one of the areas of tax incentives. Okay, you don't have to qualify, you don't have to apply. It's by default available for all new entities except those passive company. So when I say passive, meaning you are doing investment holding companies, just passive income. You're taking dividends, right? Interest, some property investments. Yes, you're not entitled to qualify. But having said, you still qualify for subsequent years. Okay, so there's actually two types of incentives. There's a full tax exemption scheme and the partial one. So all companies entitled to partial. Okay, so actually there's a distinction between investment holding and investment trading. So if you are doing investment as part of the trading activities, you are considered a trading company, a trade, not an investment holding. So you qualify for all the incentives that are available for just like a normal company, right? Okay.
Okay, that's pretty comprehensive. Thank you very much for that. So that kind of was a great segue into the second question, which was submitted. Can I use a Singapore private limited to hold shares in my investments? So basically an investment holding company. So I'll comment on the US side before we come back to you for the Singapore side. For a US side, obviously, yes, you can, but it tends to be not very tax efficient, the default, unless you make certain elections or you do something to the structure. From a US tax perspective, it won't be very efficient. And the reason why is because it triggers something called a PFIC, or Passive Foreign Investment Company. That's PFIC, for those who want to check it out. So this was a designation that was created in the 1980s in the tax code. And it basically was a response to the financial services industry in the United States that was saying that essentially a US person could invest outside of the US and experience more preferential tax treatment. So as a result of that, the PFIC regime was established, which, to be completely honest with you, it does the complete opposite. It almost penalizes US exposed persons. So this would be individuals as well as entities who create investment holding structures outside of the US. And again, there are ways of mitigating this. You speak to your tax advisor, but the default is an unfavorable treatment. And that definition of a passive foreign investment company is triggered by very specific thresholds in terms of the level of income. So once the level of income being operational or passive, once the passive income exceeds a certain threshold, PFIC is triggered. And similarly, when you look at the balance sheet of the company, if more than a certain percentage of the assets are held for the production of passive income, then again, it's triggered. So that leads me to what you said previously, Boon Yip. Are there like very specific thresholds for that investment holding structure in Singapore, given what you mentioned previously?
Okay, investment holding companies are typically very least incentivized. So basically, they don't have a lot of incentives available, because if you receive dividend, they are not taxed. So all the dividends channel out to the eventual shareholders are not taxed again. So it's a first year. So that is why it's very minimum incentives available for the investment holding companies.
Understood. So moving on to the next question that was submitted. What is a QEF election? So this, again, it seems everything is flowing on from the previous question that was posed, in that we've established that investment company or holding company structures, they are not treated in a tax preferred manner by the US tax code. So one of the ways that some people deal with that is making what we call a QEF election under section 1295 of the tax code, where essentially the structure it's treated as if in the same manner as a US mutual fund structure. So it mirrors what would have been done had this structure been established domestically as in within the US. So the gains or the distributions retain their character. So if you have capital gains, then it's treated as capital gains on your return when it flows through to your 1040. This is assuming, so this type of election tends to be made at the beginning of your holding company structure. When you fail to do that, if you fail to make this QEF election, then you have these aggressive look-back rules and throwback rules, where because what the PFIC regime seeks to do, just keeping it very, very top line, it basically taxes you on what we call phantom income. So income that has not even been distributed yet. Once there's income within the fund, your investment structure, then even though it didn't get distributed to you as a salary or bonus or dividends or interest, whatever it is, however it is, you're going to pull it out, it is deemed to have done so, and you're going to pay taxes on it. In addition to which, you have holding gains. So for example, if you create a holding company structure and you invest in a startup in Singapore, like many of our clients do, the startup scene is of course very vibrant. And the shares in your startup, the startup that you've invested in, it is appreciated in value with subsequent rounds. You know, with each round is a reevaluation of the share price, and it goes up. But you haven't sold anything. You haven't recognized. There's no recognized gain. You haven't sold anything yet. You need to declare that, increase that appreciation. You need to include that on your tax return. Now, if it is that you do have a holding company or a PFIC structure, and you fail to make those declarations on a year-by-year basis on your tax return, some aggressive throwback rules are invoked where you're taxed at your highest marginal tax rate, which right now is around 37%. And after the Biden tax increases, one would expect that will go up. So it's the highest marginal tax rate for the prior years, plus interest, plus penalties. So it becomes pretty draconian depending on your situation. So one of the workarounds on this is what we call a QEF election under Section 1295. So this is assuming that you've dealt with all the Section 1291 gains that we've just discussed, where you made gains or you made income, but you didn't declare it on your tax return in prior years. So you need to clean that up, or you need to cleanse the PFIC of this taint, because it's called a tainted PFIC. So once it's not tainted, you can make that 1295 election. Sometimes you can make it even though it's tainted, but we don't advise it. So you make the 1295 election, and you're able to not comfortably, but in a tax efficient way, declare it on your tax returns on an annual basis. So we work with investors who do have holding company structures or who do have investment structures in Singapore to make that QEF election and prepare the annual statements, because it also requires that you prepare the accounts in a manner that's recognized by the IRS in order to enjoy that benefit. So that is a workaround to this PFIC dilemma or situation that we discussed previously. So we can talk about that offline if you have further questions on it. Next question. What are the steps for giving up my US citizenship? This is a question, and we're not the biggest team in the world, but we help probably 3 or 4 clients each month give up their passports or green card. But having said that, it's not like there's a gross exodus from the US, because we have many more clients enter the US in terms of pre-immigration planning. So, you know, just kind of balances itself out. The steps in giving up your passport are twofold. Same with your green card, right? There's the immigration side and there's a tax side. So in terms of the immigration side, that's relatively straightforward. You can go to the embassy website. I know it's been pretty difficult over the past year to get appointments because embassies across the world have been subject to reduced operations for obvious reasons. I won't say the word why, because then we get censored on some of the platforms that we publish on. So for obvious reasons, embassies have been functioning at reduced operating hours and functionality as well. But I believe that things are slowly but surely returning to normality. So please reach out to the embassy in Singapore online. And you can book an appointment. You go in, you explain. By the time you go in, you need to have a second citizenship. Many people, of course, would have Singapore, but others, you know, Australia, New Zealand, European citizenship, whatever it is your other citizenship is, you go, you declare that to them, and they ask, are you sure? You say yes. And then sometimes they take it from you right then, or they give you a second appointment to come back. Depends on the consular officer that you're dealing with. And the important thing is that once it gets there, the form, the paperwork gets sent to the State Department, and comes back to the embassy, you get something called a CLN, a Certificate of Loss of Nationality. And that's backdated to when you first went in. So that's that. The other side, which is perhaps a little bit more complicated, would be the tax side. So in order to properly and comfortably give up your citizenship, you need to make sure that your last 5 years of tax returns in good order. So you may want to work with a tax professional to make sure that they're okay. And there are no outstanding issues, get them corrected if there are any issues. Then once you give it up, let's say you gave it up sometime in September, then in 2022, when you're doing your 2021 returns, you'll do a dual status return, which will be for January to whatever date in September you gave it up. You will be doing a 1040 as a US person. And then from whatever time in September to the end of the year, you do a 1040 NR, NR being non-resident as a non-US person, so dual status. And you do something called an 8854, which basically tells the IRS, goodbye, I'm gone. And that's it. We do deal with covered expats. You trigger covered expat status, typically in one of two ways. If your net assets are in excess of $2 million at the time in which you give up your US citizenship, or if you're a long-term green card holder, like 8 years or more, and you do have more than $2 million in net assets, covered expatriate status can be triggered. Or if your tax liability over the past few years has been in excess of, let's say, $160,000 or so, then you'll be considered a covered expat and you will be subject to an exit tax. You can speak to us if you want to calculate that exit tax and perhaps put some measures in place to try and mitigate or reduce that exit tax liability. So that exit tax is calculated on a mark-to-market basis. You list all your assets on like a balance sheet, and you pretend, so there's a deemed liquidation as at the date of the expatriation. If the asset is appreciated in value, like stock, shares, real estate, whatever, then whatever that delta is between basis and whatever the book value is or market value is as at that time, that'll be subject to an exit tax calculation. So please reach out to us. We can hold your hand and work you through that process. Next question. If I get stock options from my Singapore employer, what's the difference between how Singapore and the US taxes them? So, we're talking about whether it's a qualified from a US tax perspective, if it's qualified options or non-qualified options. Let's assume it's non-qualified options, which it tends to be because it's Singapore. Then you're paying tax. So when you exercise that option, if there's a delta between the exercise price and the market price, then you would have received the benefit, right? So whatever the market value is, less what you paid for it, that you record that as income. And then when you sell it on, then you have capital gains. So if you sell the shares, normally there's a lockup period anyway, but let's say you're able to sell it within 1 year, then you'll be subject to short-term capital gains. And if you sell it beyond 1 year, so your holding period is more than 1 year, then you're subject to long-term capital gains from a US perspective. Obviously in Singapore, there are no capital gains. I think where people really get caught up would be there's some deemed exercise rules, right? So if it is that you have options, so for example, if you got options and they did not vest as yet, normally the taxes aren't triggered both in Singapore and the US until something vests, right? So it actually comes to you. When it's not yet, there's nothing, if it's just an option or there's nothing tangible that you own, then there's nothing to tax. So we tend to look, both Singapore and US, we look at the vesting schedule. And when you get shares and let's say they're just an award for service rendered, then, that's pure income to you as at the date of vesting. Now, one of the key differences between Singapore and the US, and this is where people come to us complaining, would be the deemed exercise rules that Singapore has. So if it is your contract comes to an end, or maybe you switch employers or whatever the case, typically when your stint in Singapore comes to an end and you are moving on to another jurisdiction or returning to the US and those shares did not vest, if those shares were earned while you're working in Singapore, the options were earned or awarded to you while you're in Singapore, even though they didn't vest and they're only taxable when they vested, Singapore has these deemed exercise rules and they will tax you on them even though they have not vested. Now that can become a problem for people for whom they will never exercise the option because they've left the company or they don't meet the terms of the award, of the vesting. So then we work with Boon Yip and his team, and it is possible to reach out to IRS, the Inland Revenue Authority of Singapore, and have a conversation with them and let them know, hey, we've left the company. We see this in with some of the bigger tech firms, US tech firms that have an operation in Singapore. They're leaving, but they are not entitled to the shares. So there will be no vesting. And once IRS sees the documentation and is assured that there will be no vesting, then the deemed exercise rule would not typically be invoked. So I'm just going to have a quick look at some of the other questions that are coming in. Okay, great. Moving down to number 5. I'm a Singaporean who studied in the US and I now have a green card. Okay, so you're a green card holder and you're living in Singapore. Okay, fine. My Singaporean father passed away. I'm sorry to hear that. And I was named the beneficiary of his revocable trust, a Singapore revocable trust. What are the implications from a tax perspective? So when your dad passed, that revocable trust, which is known in US tax terms as a grantor trust, becomes irrevocable typically, or a non-grantor trust, an irrevocable trust. And you are therefore the beneficiary, US exposed beneficiary of an irrevocable trust, or foreign irrevocable trust, or foreign non-grantor trust. I recommend that you do get qualified advice. And to be fair, the trustees in Singapore are pretty clued up. So once they know you have a green card, they're going to tell you, hey, you need to get advice. And so you should follow them. And because what that means is that you'll be subject to disclosure on your tax returns, on your US tax returns. You'll be typically subject to disclosure. Now, there may be some elections that can be made to delay the disclosure in your returns, but ultimately the bottom line is that there will be disclosure in your returns. And the nature of the disclosure on your personal tax returns as the beneficiary of a foreign trust is a function of what's in the trust and the nature of the distributions from the trust. So please, you speak to either our team, you can reach out to us, or any one of the US qualified teams in Singapore, and there are probably about 10 of us. So pick whomever you feel comfortable with and have that conversation, because the longer you delay, there are more penalties and interest and so on that may accrue to you, even though you haven't got anything. You did not take anything from the trust. By merely being a beneficiary, you will have the US tax implications. So please get advice. Next question. I'm a US citizen who's married to a Singaporean. I'm on a long-term PR. So this person is a US citizen and a permanent resident of Singapore. I have assets and investments of around 10 million, and I want to leave them to my Singaporean wife and our kids in a way that avoids probate and is tax efficient. So we are tax advisors, so not really like investment advisors. So we need to tread carefully. But at 10 million, you should be above the threshold for some of the private banks in Singapore, such as Bank of Singapore, and so on. Yeah, some of the Swiss private banks as well may be able to onboard you. So have that conversation, because one of the simpler and more elegant solutions that we see our clients use is to just form a trust, a foreign grantor trust, or basically a revocable trust. So what that does is, by having a revocable trust, once you pass on, it becomes irrevocable typically, and you avoid probate for the assets that are in the trust, and it goes to the beneficiaries, the named beneficiaries of the trust. And you also get some element of asset protection as well, which is important, especially if the children are younger and maybe still in school and whatever. So they may need some sort of protection or guidance as to how their assets should be enjoyed or consumed. So I would speak to a private banker, and if you don't have one, because some of them are a bit gun shy when it comes to US exposed persons, you can reach out to us and we can introduce you to trustees in Singapore that do manage assets for US exposed persons. So that's something we can do for you. That's no problem at all. Number 8, I've been in Singapore for a while and I have not filed US taxes. How can I catch up? You're not alone. Lots of people, it just kind of slips your mind, you know, you get caught up in other things, you forget, whatever the situation may be. So as to how it is treated, it really depends on whether your non-compliance was willful or non-willful. So that concept of willfulness is not discussed in tax code. So we look at case law. And what the case law tells us is that if it is that you intentionally sought to avoid your responsibility, so essentially towards the side of tax evasion, so you intentionally avoided and evaded that known legal duty, then you may be on the side of this spectrum where you need to do some sort of voluntary disclosure. Now, there was an offshore voluntary disclosure program up to a few years ago, but it was discontinued under the Trump administration. So, but there are ways of voluntarily disclosing your situation in the IRS manual that we work with attorneys to walk you through that process. If it is your non-compliance is deemed to be non-willful, so you didn't intentionally, you just forgot, whatever, we can work with you under what is called the streamlined compliance procedures. So that is typically what probably 90% of our clients use to go through their coming clean to the IRS. Now, it's important to understand the way the IRS works. Just like most tax authorities, even the one in Singapore, they prefer you come to them before they come to you. If it gets to the stage where they have to chase you, the conversation is not as pleasant as when you come to them first and say, hey, made a mistake, I didn't declare X, Y, and Z, here the prior year returns. Because in the US system anyway, under streamlined, it's an amnesty in all but name, and you get to avoid the penalties, both civil and criminal. And the penalties can be pretty aggressive when you look at them. You know, it could be $10,000 for each unreported entity that you've invested in. It could be up to 50% of the value of your bank account per year. So we saw a case of a resident of Florida that had a bank account outside. Actually, there was one with a bank account in Singapore as well. But I'm thinking about, I don't know what happened to that guy. He had one at, I think it's UBS in Singapore. There was another guy who had one in Switzerland. He had $1 million in an account, and the IRS deemed that he did not report it for 3 years. So they went after the maximum, which was 50% for each year. So they charged him $1.5 million as a penalty and an account with $1 million in it. So that's how aggressive they can be. So you always want to get to the IRS before they get to you. That's the point. And how do they get to you? Because of something called the Financial Accounts Tax Compliance Act, or FATCA. Every financial institution, every institution that's licensed by the Monetary Authority of Singapore, is legally obligated to conduct KYC exercises, know your customer exercises, to ascertain whether any of the account holders are US exposed. And even if you open your account with another passport, because many of us have more than one passport, right? And you did not declare, if it is that the financial institution suspects that you are US exposed, even if you deny it, they're legally required to report you all the same. So that creates checks and balances in the system. So the bottom line is, it just makes sense to come clean to the IRS before they find you. So with streamlined, there's a look back period. So even though you may not have filed for like 10 years, the look back period is 3 years. So you just filed the last 3 years, so your due date has already passed, and the last 6 years for FBARs. And again, interest, but usually no penalties, and you're good to go. And of course, you write a statement and you promise to do the right thing going forward. If you want to discuss that further, please feel free to reach out to the US qualified tax advisor of choice, or you can email us, reach out to us at our offices, and we'd be happy to help you. Next question. Okay, somebody sent a message. Will you all be publishing the recording? It looks like I'll be unable to join due to the Jewish holidays. Apologies, when we set the date, we didn't realize. I knew it would be Labor Day, right? But I didn't realize it would be infringing on a religious holiday. We'll try our best not to do that in the future. We need to be sensitive. But to answer your question, yes, it'll be published on Facebook. It'll be published on wherever you can get your favorite podcasts, whether it's iTunes, SoundCloud, Google Play, Amazon. We publish it on over 20 platforms. So it will be available. The easiest place is probably to get it on YouTube, hcj.tax. That's our channel on YouTube, or on Facebook. Again, hcj.tax, do a search and it should pop up. And on Facebook, it'll be available immediately. It's being live streamed right now. So once we're done, it'll be available for viewing right after. Next question. In the US, companies have access to various tax credits to help businesses during the health crisis and the lockdowns. Is there similar support for foreign-owned companies in Singapore? Boon Yip, this one is for you.
Okay, right. Yes, so if you look at the Singapore tax system is on territorial basis. So irrespective of your status, so if you trade, I mean, if your income is generated in this territory, okay, you're entitled to the scheme, right? So a very good example would be foreign branch. Okay, sorry, a Singapore branch of a foreign company. So okay, they are just like a typical company in Singapore. So they enjoy the incentives that a normal company in Singapore, and most of the tax rules are the same, applies to them. So do the grants for COVID that given out to the employer. So they do enjoy. Yeah.
Okay, that's great. Thank you very much for that. So we're getting some other questions coming in now, but I'm just going to try to stick to the order just out of being fair, right? Next question, this would be number 11. For investing in stocks, and I guess this would be shares traded on US exchanges, is it better to use a US bank account, a Singapore bank account, or if I have a non-resident alien spouse, I guess he or she's married to a Singaporean, their Singapore account? And I'm not sure, questioner, what you mean by better, but what you just keep in mind, well, let's create some context. From a tax perspective, the treatment, whether you as a US person invest using your US bank account and presumably your address or Singapore, would be the same, because any gains get reported on your US tax return as they would normally be, and any losses would be deductible subject to passive activity loss rules. So it's business as usual. Now, if it is that your partner, who is Singaporean, 100% Singaporean, not a US person, if they invest in US shares, then their tax treatment will be slightly different in that there's the dividends, or depending on what the security may be, it'll be interest. So dividends and interest will be subject to FDAP rules. FDAP stands for fixed something periodic, fixed discretionary annual periodic income, something like that. Sometimes forget what that acronym stands for, but basically it'll be subject to 30% withholding. Now that withholding is reduced by treaty, but because Singapore has no tax treaty with the US, there's no reduction. So he or she, as a non-US person investing like shares in Tesla or Microsoft or whatever, the dividends will be subject to 30% withholding, but capital gains are tax-free. So non-US person investing in US shares, typically capital gains are tax-free. The exception would be if the underlying assets may be real estate. So real estate is treated separately, but just normal securities will be tax-free. So it matters less where the bank account is and more who the ultimate beneficial owner of the investment will be, or what structure that you use. So I hope that helps you. Next question. I'm a US citizen and Singapore PR, another person, right? Do I have to declare / how do I declare my CPF account? So I think you anticipated the answer. Yes, you certainly do have to declare your CPF. So many people don't, and especially those who use US tax teams outside of Singapore, they honestly don't know what a CPF is. And there's no real guidance to explain to them how to be treated. But we have actual guidance from the IRS back in the days, for those who've been in Singapore a long time, when the US embassy in Singapore had an IRS desk in the embassy, back in the days when they had the budget. They issued a memorandum which explained what the CPF is from a US perspective and how it should be treated. So we have that memo because we've been here for a while, but essentially it is treated, the interest, you get your annual statement from the CPF portal, you just log in and you can download it. And the interest or dividends, depending on how long you've been in the CPF or whatever, that will be declared as income on your Schedule B. And the amount in this CPF account is declared on your FinCEN 114 or your FBARs. FBARs stand for Foreign Bank Account Report. So on the FinCEN 114/FBARs, that's just a report. There's no tax implication to that. But the returns, even though you didn't get anything from the CPF, it's just a return in the fund that's reportable on Schedule B. And if you trigger a Form 8938, or otherwise known as a FATCA form, the CPF goes there as well. So that's a great question, Lindsay. You really do need to make sure that your tax team is reporting your CPF. Next question. Does a Swiss dependent pass holder married to a US citizen need to file taxes if she has her money invested and is trading stocks? So I'll divide that question in two, right? So if you are, as you say, a Swiss dependent pass, so you're not a US person, but you are married to a US person. If it is that US person, your partner has a choice as to whether to file separately or jointly. If your partner is filing separately, then no. Your name goes in the return because the IRS is nosy like that. They want to know who US persons are married to, but you don't declare any of your income. If it is that you elect to file jointly, under Section 601(3)(g), you can make an election for your non-US spouse to file jointly with you. Then yes, all your income and everything is going to be declared as if you were a US person. But typically the answer is no, you don't declare your stuff. Now, if you have, then the second part of your question, like you're investing and trading in stocks, it depends on where those stocks are. If it's on the SG exchange, Singapore exchange, or if it is in Europe, basically outside of the US, then no, it's not subject to US reporting. Once your US partner is not involved in it, it's not subject to US reporting. If it is that your shares or you have invested in the US, in US securities, then it would be treated as I mentioned before. The dividend and interest will be subject to 30% FDAP withholding, and capital gains will be tax-free. Okay, so I'm going to switch to Facebook because there have been some questions coming through on Facebook as well. So thanks for those on Zoom who've been asking questions. So James is asking, I'm new to Singapore, and yes, I'm aware that you get to exclude the first 100K of income and then pay. Okay, right. So James is just commenting on the foreign earned income exclusion, which is the main benefit. This is Section 911 of the tax code that accrues to US persons who are living and working outside of the US. So he mentions 100K. So I think for 2020, it might be like 107. It moves up with inflation each year. So each year the IRS declares how much it is. And absolutely correct, James, that amount of money is sheltered from US taxes. And what is earned above that will be subject to tax at whatever the marginal rate is. And you can benefit from Section 911 in one of two ways. It could be as a bona fide resident or the physical presence test. The physical presence test is what everyone understands because it's quantitative and it's objective. So once you spend no more than 30 days, let's say in the US, so you don't spend more than a month in the US, and you remain living and working outside, you qualify with physical presence test and you enjoy the foreign income exclusion. The other way of qualifying for it is under the bona fide residence test, and that is subjective and more qualitative. So that's a test of intent. So basically the IRS is asking, well, you know, where's your heart? Where's your real home? So it asks the leading questions on the form 2555, like, you know, who's your employer? Where's your employer located? Is your employer in Singapore? In Singapore, do you like rent your apartment? Do you rent your home? Do you own your own home? What visa are you in Singapore under? Because if you're there on a tourist visa, that's not compelling. So basically they're looking for indicia that indicates that you are a bona fide resident of whatever foreign jurisdiction it may be. And once you establish that, then you get to enjoy the foreign net income exclusion as well. So that's the main benefit for expats working overseas. Next question. I'm a US citizen on a local contract in Singapore. What type of deductions, if any, can I use when doing my US returns? Aside from our kids, we no longer own anything back home. Thank you. Well, that's a great question. So the main deduction will be, well, the housing deduction as well, which is also in the form 2555, along with the foreign earned income exclusion. So that's a big one. And the housing deduction is determined by the IRS. And they publish a table every year. So obviously Singapore is a high cost jurisdiction. So the amount that you get to deduct for your housing deduction can be much higher than, let's say, KL or Jakarta next door. So that's a key deduction that you want to make sure that you're enjoying and you're getting. Along with that, you can get your utilities as well. So your SP bills, not phone, not stuff like that, but your SP bills, you can get that as well. And other deductions mainly were around unreimbursed business expenses. I'm assuming because you're in a local contract. So unreimbursed business expenses, that used to be a big deduction, but after the Tax Cut and Jobs Act under President Trump in 2017, that the ability to enjoy that was drastically reduced, in addition to which the standard deduction was pushed up. So have a talk with your tax advisor, make sure that you're getting your housing deduction, and go through your unreimbursed business expenses and maybe any medical expenses, because costs of medical care, of healthcare in Singapore is pretty high. So if it is that you have bills of that nature, they may allow you to get a deduction on Schedule A. Okay, I'm just going to look around to see if there are any more questions. Again, feel free to type it in the chat box below if you have those questions. Okay. All right. Oh, here's another question. Continuing on my previous question, does she need to file taxes in Singapore? Okay, this is the US citizen married to a Swiss dependent pass holder. Does she need to file taxes in Singapore? I'll leave that one with Boon Yip. So this is this follow-up question from Brandon. So US citizen married to a Swiss dependent pass holder living in Singapore, and the non-US person, Swiss citizen, okay, he's corrected, Swiss citizen, she or he or her part, yeah, she is not employed, but she does have passive income, investment income arising from outside of Singapore. Would it be taxable in Singapore?
So it's an individual. So if you don't have any income, employment income or trades from Singapore, business income, you are not required to file any tax. Okay, so all investment incomes. Okay, so if you hold stocks, right, you receive dividends, they are tax free. Okay, you don't have to declare in the Singapore tax. And of course, if you have some interest you did some investment and you receive some interest at the individual level is again not taxed. Yep.
Okay, I hope that answers your question. Trading.
Yeah, you have to again, it's territorial basis. So if you have trade in Singapore, obviously you need to file tax irrespective of tax paying position, unless your company is dormant. Okay, so no activities, just subject to statutory and statutory expenses, then you don't have to file tax, and there's actually an avenue for you to submit an exemption from filing annual tax to the IRAS. Okay, so if you are a trading company, be it partnership, sole proprietorship, or a private limited company, you are required to file tax.
All right, so overseas investment, definitely, not definitely, but potentially no to taxation on overseas investment income. But if it is that you have trading income, even though the trade may not be done within Singapore, but you are managing the trading business and it's happening outside of Singapore, but because management and control of whatever the operation is being exercised in Singapore, even though the income may be earned and going into a bank account outside of Singapore, the point is that the management and control of whatever the trade is happening in Singapore. Therefore, it may be subject to Singapore taxes. Okay, that's pretty clear. And please feel free to reach out to Boon Yip directly to have a deeper dive into that to that topic.
So sorry,
sure. Go ahead.
Just another question about personal trading. So I'm unsure what is personal trading. So perhaps it's just like personal trading can be deemed a sole proprietor, can also be deemed a partnership. Okay, it's not a corporate. So you have to, if you have trade income, you have to file tax. Yeah. Okay. There's no such thing as a personal trade computation. Okay, it goes into your personal tax. So whatever trade income, okay, you have to prepare a separate P&L. All the business expenses, okay, directly attributable to generating of income in the production of income are allowable, and you have to come to a profits, and that profits is taxed. That bring them down to your personal tax level, and you will tax according to your tier. Yeah, so the highest tier in Singapore is 22%. It's quite high. Yeah.
It's quite high. It's quite high for Singapore, but for the US, and other jurisdictions, it still is very attractive, Singapore. Yeah. So, okay, thanks for that, Boon Yip. And of course, Brandon, if you want to have that conversation, please reach out to Boon Yip, and you guys could, have a more meaningful exchange on that. And Boon Yip is happy to help. You're welcome. Sean, Sean is asking, if you're earning below the foreign income exclusion, is there any significant advantage to hiring a tax advisor? What kind of costs shall you expect? So it really depends on your personal situation. At the end of the day, the tax codes, they may be complex. On the federal side, it's over between 8 and 9 million words. And then each state has its own thing going on. So it could be quite involved, but I've seen expats who are happy to take a dive into it and to explore it and understand it on their own. So if it is that you want to do that, I'm sure you're perfectly able to do that. Otherwise, you can speak to us or any other tax advisor that does international US Singapore tax. In terms of our fees, just as an indicative fee of federal returns, they start at 800 Singapore dollars. So that's if it's a simple federal return with no investments, no PFIX, no whatever, it's just a pure salary and there's no state, there's no nothing. And it's below the foreign income exclusion threshold, you're looking at about 800 Sing. So, especially if you're new to working outside of the US, you may want to have a look around and look at the way the tax rules are different for international as opposed to US domestic. Even if you use, I know a lot of people try to use not QuickBooks, but TurboTax. TurboTax is from Intuit, which is probably the largest tax software provider in the US. So they have a suite of software starting at the lowest end of the scale. They have TurboTax, I think, and then they go all the way up to Pro Series, Lacert, and all sorts of stuff. So they're running a business, obviously, and I respect that. But the point is that for TurboTax is kind of built for lower income US domestic returns, because when it comes to international returns, not all the forms are available on TurboTax. So you'd have to manually prepare them and add them to the return. Because the reason why is that they would include the international forms, but they'll charge you more for that. So you need to upgrade to Pro Series or Lacert or one of the others, which have a much higher price point. So my point is, have a look at the software, have a look at the forms that are required, and try it out. And if you feel comfortable doing it, go for it. Otherwise, you may need to enlist some professional help. Any other questions? I'm just gonna have a quick look at what they're saying on. Okay, so I have another question. Are we able to deduct rental housing costs even though my company pays half or some of the rent? Right. So this is a question about the housing deduction, which goes in the form 2555. Yes, you can. So if it is that your company is giving you a housing allowance, that is taxable income to you, and that's part of your gross income anyway. So it matters not what the allowance is for, whether it's for school or it's for that trip back to the US once a year, or for maid or driver or whatever, right? All the income is treated as gross income, and it's purely taxable. We just want to see what the dollar amount is, and that is taxable income on your 1040. Now, if it is that you do use some of that to pay for rent, then it would be deductible as a housing deduction on your form 2555. So basically it's going in one side and out the other, if that makes sense. It's coming in at the top and then you get a deduction for it below. So, yep. Any other questions? All right. I think that's it. Thank you very much for joining us. If you want to reach out to Boon Yip, for those on Zoom, you can see his email address, and you can look for Boon Yip on LinkedIn as well. His email address is Boon Yip. You want to tell everyone how you can be reached? You're on mute. You need to unmute yourself, Boon Yip.
Sorry. Okay. So I've just sent across my email address, and feel free to just send me any question you have. Try my best to address them.
Okay, great. And for those on different platforms or listening to the audio only version, it's y.yee. So y.yee at mooresrowland.sg. So that's y.yee at mooresrowland.sg. And our email address is on the US side, it'll be help@hcj.tax. And we look forward to seeing you at the next live stream. Everything that we do is on our website at hcj.tax. You can see upcoming live streams, or you find ways to reach out to us. We also have a rich library. We have literally thousands of articles on US tax and international tax in general, as well as hundreds of videos. We do a video every day with tax advice that we think would add value to you as you plan your career and you plan your investments and your businesses. So again, thanks for sharing your time, and we'll see you next time. Bye-bye.
Thank you. Thank you. Bye. Bye.
Here are 4 ways we can help you. Number 1. Sign up for free webinars on US expat taxes and international entrepreneur taxes at www.htj.tax. Number 2. Stream premium educational videos at www.htj.tax. Number 3. Contact us for tax optimization consult over Zoom. Number 4. High net worth. We can quote for doing your US international taxes returns. Our books and upcoming event are available at htj.tax. Please subscribe, like, share, and comment below. Email us at help@htj.tax to engage us, to advise on international tax or business matters.